You're watching the Melanie's Matters show, where we highlight artists, business owners, and we always talk about the matters of the community. Today's guest, Zen from Zen's Accounting Service. What you don't know about your taxes can hurt you. Now, without further ado, Zen Smith. Hello everyone, and welcome to the Melanie's Matters show. I'm very excited about today's show simply because it's tax season, okay? And I know a lot of us do not do as we are supposed to do on our taxes. I know we leave a lot of money out there. So to help us to dispel all of the things that happen, we have Ms. Zen Smith here. And guys, wait till you hear her resume. Zen, welcome to the show.
Thank you, thank you.
Oh, yeah, you're absolutely welcome. So Zen, before we get into the ins and outs of taxes, just tell us a little bit about the history of Zen Smith.
Wow, before I do, I just want to say, having a little struggle with the voice, but this is too important not to do this today.
That's right.
So we're moving along and getting this done in a great fashion.
Absolutely,
yes.
Absolutely, absolutely.
I worked for the Internal Revenue Service probably about at age 17 through Morgan State University through their cooperative education program.
Wow.
So when I graduated, I already had a job working with them. I stayed with them I think about 5 years, and I left and I started working in private industry. As I was working in private industry, I was like, you know, I think I can do this and also, you know, start working on doing some taxes. Can't do taxes when you're working for the Internal Revenue Service. So conflict of interest there.
Okay.
So I started doing tax returns, and I also have a degree from Morgan State in accounting. And so I also started working on books and records. It got to the point I had to make a decision, either do this full time or stop and, you know, just give it up. But I felt moved by the Lord to just go forward with it.
Wow.
And I've been doing it for about 35 years now. And I thank God for the blessing and the opportunity. There's just so much knowledge that is important for people to know, that they can save tax dollars. Yes, and so that's the important thing, is the planning piece of all that you do.
Okay. Great. So guys, as you heard, you know, Zen has extensive knowledge in this. So, and that's why I invited her to be on the show today, just because I think a lot of times we need guidance, not just from the business perspective, but also from the individual perspective when you're filing. So Zen, what are we starting off with?
All right, well, the most important thing you need to start off with, before you go to your preparer, you need to get your records together. Okay. That's the most important thing. So you're not going back and forth about, oh, I forgot this, I forgot that. The easiest way to do that is to take a copy of your tax return from the year before, take a look at it, and make sure you have all the records that you had from that particular year. Now, if there's some things you don't have, then you can just mark that off the list. So that's the important place to start, is to gathering your records. But more importantly, picking the right person to do your taxes is the most important thing of all. I say there are basically 3 kinds of tax preparers. There's the shyster, there's the paper pusher, and there is the tax planner. So the shyster is the person that the IRS has kind of clamped down on. That's the person you could go into their office, you hand them all your paperwork and give them everything. You know, they kind of flip through it. They got to put in some of the basic stuff to at least make it look like it's correct. And they put a lot of fictitious information on your tax return. And you wind up with a huge refund, usually $5,000 to $10,000. So they never go over the tax return with you. It's like, oh, your refund, you're so excited about the refund. You never go over the return. They give you the return. But you never go over it or look at it. And maybe a couple years later, till you get audited, and the IRS wants you to come in and verify, you know, that $50,000 in contributions that they said that you gave. Yeah, so those are the shysters. The IRS has cracked down on them, so it's a little bit harder for them to do that now. Because what the shysters would do, they wouldn't sign the returns. Okay. Yeah, so now it's kind of hard because you have to be registered if you're going to electronically file. So that cuts down on a lot of the shysters. Okay. If there's a crook out there, there's a will, there's a way. There's, you know, they're going to try some other things, but you don't want a shyster. Okay. And then, so when the way you can determine a person is a shyster, if the person doesn't want to go over tax return with you, I mean, you can just ask them the basic questions. Okay, you're gonna go over this tax return with me. I'm gonna understand everything that you're doing. You're gonna show me all of the paperwork and everything that you're putting in. That's real important. And make sure that they're electronically filing it. If they're not electronically filing it, they're gonna put it in the mail. Then you really need to go over that return because you're responsible for what's on that return.
Wow. Hope you guys heard that. I really hope you heard that one. Okay, go ahead.
All right, and so the paper pusher. Okay. So what do you think the paper pushers are?
Pushing that paper, getting them in, getting them out.
That's exactly what it is. That's exactly what they do. Right. They take your information and legitimately put it on the income tax return, and that's it. So you owe, $4,000 or $5,000. Oh, okay, well, this is what you owe, and then you just have to pay it. Or you could have maybe a $5,000 or $6,000 refund, and you might think, "Dad, I could use some of that money, during the year. Is there something I can do?" They're not going to help you and assist you with any of that because they're just pushing the paper. So the pushing paper folk, you can get them, pretty reasonably priced. Right. But you get for what you pay for. Definitely. What you want. What do you think you want out of those three?
You want a professional person. You really want a professional person that knows what they're doing.
Yes, you definitely
want a partner.
Yes.
A partner.
Yes.
You want a partner.
Yes, a tax planner. That's really key. Tax planner is a person that's going to be with you all during the year. After the taxes are filed. They're giving you tips on things that you need to do all year. So when you file your taxes, you're not putting yourself in a situation that you owe. The best scenario that even the IRS applauds is that you really don't owe them, they don't owe you. It's kind of close with the figure. Some people feel like, well, I can't save my money, so this is the way I want to get it, is getting a big amount. Well, you could have that money. Just think, if you're getting a $5,000 or $6,000 refund, that could be an additional $500 in your budget for the month. Wouldn't you really want to have that as opposed to waiting? And so that can be done, but you need to go to a professional tax planner to have that done. You don't want to try that on your own because there have been nightmares of folks.
I can imagine, and you do not want Uncle Sam in your business. You don't want him sending you a letter saying, "Hey, you owe me."
Yes, and that's what will happen. A lot of people will try to do it on their own, and they may claim like 20 people or something crazy like that, and have no withholdings, and then wind up owing a lot because they're trying to figure out, well, how do I do this? You need to have a professional actually do that. A professional will take your information from the year before, your current information, and ask you a bunch of questions and different things so they can determine what your situation is going to be, and then they can tax plan within at least $200 either way of getting a refund or maybe owing. As long as the taxpayer is, pretty accurate with the information, because some of the things you'll have to estimate.
Yes. That makes sense. On that note, ladies and gentlemen, we're going to take a very, very brief break. So be right back. You're watching Melanie's Matters TV and radio show. A word from our sponsor, Zazena Accounting Services. Now, back to the show. Okay, ladies and gentlemen, we are back. And we're here with Zen. Zen has already, in the first, 7 minutes of taping, she's given us a wealth of information. So we're going to talk about the person who goes to work every day and they earn a paycheck. So Zen, how can that person get more money during the pay periods than have to wait towards the end of the year?
All right, well, there's two things. Again, it's part of tax planning. Coming in with a professional so they can take a look at, see what they're doing. A lot of times, a wage earner, they have 401ks and those type of plans at their job, and they need to be maximizing the amounts that they're putting in to those 401ks because that's a pre-tax dollars. So, for instance, in a situation, let's say you gave all during the course of the year $5,000 into your 401k plan. So if your income would have been $50,000 to pay tax to Uncle Sam, your taxable income to start with will now only be $45,000. Your Social Security income is always going to be taxed at that rate,
right.
At the rate that it normally is taxed at, the 6.2. But your income tax would be lessened by the fact that you're contributing to a 401k, and a lot of people don't do that. The other side of it was what I was alluding to before about if you're a person who gets a large refund. Now, if you're a person that owes, then we need to see the other side. Why are you owing? And most of the time it's, well, I need this money to pay bills. I can't pay my bills. Well, you don't want to put yourself in a situation where you're always owing, because then you're paying more for that money that you're taking from Uncle Sam. He's hitting you with a tremendous amount of interest and penalty.
Yes.
And that is the only agency in the United States of America that doesn't need a court order to come and seize and take everything that you have.
Yeah.
All they got to do is print a piece of paper and say you owe, and here they can come knocking on the door, or just start running the tape around your stuff. And like, ain't nobody died here, but I'm getting ready to. So you don't want to put yourself in that situation. So you need to figure out what's going on. A lot of times people just not budgeting properly, which is another scenario in itself that needs to be talked about. And I usually try to sit down with the person, figure out what's going on, because a lot of times people will say, oh, I don't have any extra money. Yeah, you do. You think about the money that we waste.
Oh, yeah.
And we waste a lot of money. And the number one area that we waste, what do you think it is?
Probably entertainment.
No.
Okay.
Food.
Oh, of course. Of course.
How many days a week do we go out instead of eating at home? Maybe taking your lunch, going out to eat every week. Not to say you can't treat yourself,
right? Because
you should do that. But there's just so many different things. We waste so much money. We don't even see it. That we're wasting it because we just do it so often.
Right.
So if I look at a person's budget, I would be able to help them to, look and see other areas that they could save money. But getting back to the tax piece, so the tax planning part of it, what I would suggest that the person is getting a large refund, that they would see someone like me and I could tell them how to adjust their withholdings. So they're getting more money in their check monthly than waiting for the end of the year to have it done. And again, as I said, I would suggest not trying to do this yourself. Because you can flip yourself the other way and then you wind up owing a lot of money.
And we do not want to do that. Wow. So what are some other suggestions that you can give for those who earn a paycheck? What are some other key points?
One of the main things that I wanted to go into, and that is about the dependents and exemptions on returns. Because sometimes when you fill out your W-4, which is the form you fill out when you are a wage earner, and people put all kind of things in it. Well, I'm going to claim 10 now, then I'll do my 9 later, or, all kind of, things like that. And you can claim more than what you legally have to claim. You just need a professional to help you and assist you with that. Because if it's a situation where I'm trying to allow your paycheck to increase because you're getting that $5,000 at the end, you're getting it now more through the year, I might have you take out 8 exemptions. But that's not something you should do on your own, because then you can flip it the other way and they want to owing $5,000. So with exemptions, people need to understand about who they can claim and why. I get it all the time, especially with a lot of my new clients. I just had a client not too long ago. A new client came in and I looked at the return. I was like, oh my gosh. He had like 5 people on the return. She was claiming. I was looking at the income. I was like, oh, I'm not sure about all this. So there are basically 5 tests that you must meet and pass all 5. You can't pass 4 and miss 1 before you can claim anyone as a dependent. This is really, really important.
This is critical. This is
very critical, because a lot of people get all this confused, and it can happen a lot in a family situation where the family is living together. So everybody say, okay, all right, I'm gonna allow you to claim her this year, and then I'll take it next year. And this could be grandma, this could be the mother, and that type of thing. It even could be the father in the situation. But these are the 5 tests. First of all, person has to be a citizen or resident of the United States. Easy one. Can't be married, filing a joint return with someone else. All right, that's an easy one. Can't have taxable income in excess of the amount for the exemption. The amount for exemption for 2014 filing is $3,950. The only exception to that rule is a student who is in college, full-time student, who is in college can be exempt from the income test. Person has to be related to you or a member of your household for the entire year. And then the most important test, which is the test that a lot of people fail. They'll pass all 4 of the other tests. They get to number 5 and blow it out the water. And that's the support test. You must establish that you are contributing over 50% of that person's total support for the entire year.
Now, mind you, she said establish. So can you explain about establishing that?
Sure. Now we're going back to my audit years, so I can definitely give you an explanation of that. Yes, because that was part of what I used to do as an auditor on the individual side of it. So in establishing your support to an individual, what you first must do is, we take an example, we'll say it's 5 people who live in the household. There's 2 figures that have to come together first. You need to come together and determine what was the total support for that person, or each person that you're claiming for the year. So in order to do that, you start off with household expenses. So you total up all the household expenses that covers everything for everyone that's living here. Let's just say it's a family of 5. And let's just say the household expenses, we'll make it easy. We'll say they total $25,000 for the year. So we're talking about gas and electric, the water bill, you know, things like that. Oil, or if you have it, that kind of thing. And rent, possibly, if you're paying rent. Or fair rental value if you're buying your home. So let's just say that was $25,000. So if it's 5 people in the household, $5,000 is considered your portion to that individual for the household portion. Then you go through your personal expenses that you take care of that person with. You don't necessarily have to be a child. Clothing, it could be education, entertainment, grooming, all those expenses. So we could say maybe that was an additional $5,000. So now the total cost for that child for a whole year, we'll say, is $10,000. So let's just say for this was a teenager in college, maybe say 18 or 19 years old. And they were able to get a pretty good job during the summer. Let's say they made $15,000. So what the IRS does next is to determine who's over 50%. So 50% of 10,000 is 5. So it had to be at least 6 or a dollar more. It was 5,001 is over the 50%. So if I worked as a as the person that, let's say it's a student, so the student child that you're trying to claim worked and made $14,000 for the year, that $14,000 would be subtracted first. You're left with nothing. So then it's not to say that, we'll say in this situation, maybe it was a grandmother is not helping to support the child. It's just not over 50%. It's just not over 50%. And that doesn't matter if it's, say it's a father who is contributing support. Say his support that he's contributing in child support. Let's say it's $6,000. Then he's over 50% and should be. A lot of times they get into the thing, okay, you claim them, I'm going to claim them this year. No, you can claim them. You know, they do that. IRS though is not going to get into it unless you ask, you know, it becomes an issue. Or they question it on your tax return. Then they can say no, because it could be a situation where the custodial parent where the child is living is not entitled to claim the child, depending on how much support the father is giving. Yeah, so it's you know, you can't just say, oh, you can claim them this year, I'll claim them. And we have a lot of that go on. Okay. All right. On that note, ladies and gentlemen, I know you're learning a lot, because I am too. So on that note, we're going to take a very quick break.
You're watching Melanie's Matters TV and radio show, a word from our sponsor, JNF Enterprises, bringing visions to reality, building the 21st
Ladies and gentlemen,
century
welcome
company.
back to
the
Matters.
show.
We're here with Zen, and she's given us a lot of information on the accounting side, and we all need it, especially now during tax season, and we need it before tax season. And she's definitely doing a good job of talking about planning for your taxes. So Zen, what are we working on next? The earned income, right?
Yes.
Okay, this is a big one. This is a big one.
All right, so once it's been determined that you can claim the person as a dependent, a lot of people are looking at the earned income credit. And that's something you can't play with.
Okay.
If you play with that and the IRS finds out that you're not entitled to claim, especially if it's a situation where, we've had some situations where the non-custodial parent claims the children every year and don't give a dime towards support. And then they just get there first. File a tax return, claim everybody. So when the parent who's taking care of the child files, it gets kicked out. Right. It's like somebody else is claiming the children. So we've had situations where I had to do an audit. I told the IRS to do an audit, and then they determined that that person wasn't. So what they do in that situation is they bar that person for ever filing the earned income credit for 10 years.
Wow. Wow.
Because that was just straight up fraud.
Yeah, yeah.
Like they didn't take them to jail, put them and throw them underneath the jail. Right. I mean, you're not even supporting the child at all, but you have the gall to claim the child, take the, because they want to get all that money. So, but getting the money and getting it correctly is the important thing.
Right.
So what I have here is some information I want to share in regard to that particular credit, because people get this credit confused.
Okay.
All right, so the first thing for 2014, if you are, you can qualify, if you qualify to get the earned income credit and you have no children, if you make a low income, you can also qualify for the earned income credit.
Right.
So the dollar figure that you could get for a person that doesn't have a child, they can get from $2 to $496. If you claim one child, you can get from $9 to $305. If you have two children, you can get $10 to $5,460. If you have three children, you can get $11 up to $6,143. So, a lot of people just say, hey, it's worth it to me. $6,000. I need this money. I gotta pay a bill. I gotta do whatever. So they roll the dice. But when you roll the dice and there's another person that's involved, that's gonna come back to bite you, especially if the person pursues it. So what are the rules in regard to the earned income credit? That's the part that I want to go over, because the key word here is earned income.
Right.
It's based on the money that you actually earn. So what does not qualify is Social Security income, because that's not income that's earned, or pension income, and people want to utilize that. Unemployment benefits, that's another item that's not, because you didn't earn it. You kind of feel like you did because you worked, but you didn't pay it. It's the employer that pays unemployment insurance, and so that is considered not part of earned income, because it's based on your earned income. Person must have a valid Social Security number. They can't have investment income less than $3,350. Now, investment income is interest income, dividend income, that kind of income. Okay, the person cannot be filing separately. You can file any of the other statuses, but if you file married filing separately, you don't qualify for the earned income credit. They have to be a citizen or resident of the United States. Both parties that are involved cannot be claimed by another person. And now to give you the actual income figures. So the maximum, so for a single person or a person for head of household that does not have any dependents, if they make from 0 to $14,500 $590, they qualify for the earned income credit.
Okay.
All right? And they qualify to get based on the range that I just gave you previously.
Right.
All right, so a single person who has one dependent, you can make as much as $38,511.
Okay.
If you have two dependents, they allow you to make $43,756. If you got three dependents, they allow you to make $46,997.
Wow.
So the difference is when you're married, they let you make a little bit more. If you're married, you can have a joint income between the two of you of $20,020. You qualify for the earned income credit.
Okay.
If you have one child, you can make up to $43,941. You got two children, $49,186. If you have three children, $52,247. So a lot of people will qualify for the credit.
Right.
And as long as they follow those guidelines,
Right.
that's the part that's important. The other guideline with the person has to be related to you.
Okay.
The relationship test.
Right.
Yeah. So it can be a foster child, stepchild, adopted child, grandchildren, nephew. They just have to be related to you. So if it's your girlfriend, no, don't qualify.
Right.
Or your live-in friend or anything like that,
That's right.
don't qualify.
Right.
Yes. And the age test, the person has to be under 19 years old unless they are a student in school full-time, then they can go up to 24.
Okay.
And they have to be in your household for at least 6 months of the year in order to qualify for the credit. So if you meet those requirements, then you qualify for the credit.
Okay.
And so a lot of people will want to claim a dependent just so they can get this credit, because that's a pretty hefty. That's a pretty hefty amount. That's a pretty hefty amount. Yes. So one of the other things that's important, looking at some of the guidelines for this year, because a lot of times people ask me, well, how much money do I make before I have to file? Now here's a major thing that I want to say to all the seniors.
Okay.
Seniors think that when they turn a certain age, they no longer have to file taxes. Not true.
Okay.
It is not based on age. That's Social Security. Social Security will stop taxing them
Okay.
or penalizing them for earning money after they reach a certain age.
Okay.
You could be 100, you could be 1 year old, you could be just out the womb. IRS don't care. If a Social Security number has been assigned to you
Yes.
and you're making money,
Right.
you need to report it. Now, if it's under certain limits, then you don't have to unless you just want to get the refund back
Okay.
if money was withheld. So I'm just going to keep this on for right now for everybody that's under 65. So if you're under 65 and you're single and you make under $10,150, you're not required to file.
Okay.
All right, so if you're married filing jointly and both spouses are under 65, it's $20,300. Married filing separately is real small, $3,950.
Wow.
That's really small.
Wow.
Yeah, it is. It had a household, $13,500, and this other category is widow with a dependent. That's after if the spouse dies and they have children, it's a separate category that the IRS has. That person, if it's under $16,350, then that person wouldn't have to file. Now this is if it's wage income, pension, Social Security, that kind of thing.
Right.
This does not apply for anyone who is in business for themselves. That's a totally different game altogether.
Totally different. Totally
So
different.
if you get a 1099 for the year, and that's your main source of income,
Right.
you cannot use these requirements to determine whether you have to file. You have to file because of the Social Security tax piece that's involved. You might not owe income tax, but you may want to owe Social Security tax on the money. So this does not apply to anyone who is filing a tax return that has income with a 1099.
Okay. So on that note, ladies and gentlemen, we're going to take a very quick break. So when we come back, we're going to talk about the business side.
Yes,
we're going to talk about the business side because this is important. So we'll be right back.
You're watching Melanie's Matters TV and radio show. A word from our sponsor, Atypical Journey, which can be found on Amazon.com. Now,
okay,
back to
ladies
the show.
and gentlemen, we are back, and guess what? We're still talking to Zen. So now we're going to flip a little bit, and we're going to talk about the business side, things that you definitely want to do and not to do as far as business is concerned.
Yes.
Okay, Zen.
All right, with businesses, the tax planning is so key. Anyone that's in business, there is no reason they should take all of their paperwork and come at the end of the year to someone to prepare the taxes, because they're putting themselves in a very bad position. They could wind up owing thousands and thousands of dollars. They could have tax planned and not own anything. So that is the worst thing to do. They need to be going to a professional and periodically obtaining a profit and loss statement throughout the year, so that way we can tax plan and figure out what's going on every quarter. Do you need this in estimated taxes? Do we need to plan and figure out what are the deductions we can take to offset what looks like it's going to be taxable for this particular quarter? So that is very key. More importantly, a lot of small businesses are not set up properly. They're basically 5 entities that you can set yourself up as a business. Can you guess what are some of the business entities?
Sole proprietor.
All right, that's one.
That's one.
Okay.
Gosh. I forgot the other one.
Okay.
Sole proprietor.
2 or more people.
Partnership. Thank
All
you,
right.
partnership. And I'm going to let you say the rest because.
Okay. This is a popular one that everybody likes to form.
Yeah.
The LLC.
LLC. Yeah, that's the one. The LLC. The LLC.
The LLC, C Corp, and S Corp.
That's right.
Yeah. Those are the basic. There's some other things that are out there that different states set up, but under the jurisdiction of the Internal Revenue Service, those are the basics that most people would utilize to start a business. Now, I'm going to give you a scenario. Before I give you a scenario, let's just say, so that everybody have understanding. Sole proprietor is one individual, who has not set up a professional entity. And so they're operating on their own. And if they get sued, they can come and take everything from them because they're operating as a sole proprietor. So that was not set up to do. So a lot of people will file Schedule C if they're a sole proprietor.
Okay.
And that was mainly set up for somebody that works a full-time job and maybe sell Avon on the side.
Okay.
If you are that's your source of income is that you work as a business, you have no business being a sole proprietor. All right, so the partnership is a professional entity that you register with the Internal Revenue Service. There's no requirement to register in the state of Maryland. And you get a federal identification number. That's 2 or more people coming together.
Right.
You are protected if somebody sues you. Then the second one is my favorite to talk about because it's the most misunderstood entity.
Right.
And that is the LLC. Yes. LLC is a limited liability corporation. Now that was set up mainly in the state of Maryland to escape state taxation. And it's a little bit easier if you have real estate to put it in an LLC than it is to put it in any other entities as far as getting rid of it faster.
Okay.
And you can escape some of the state taxes. Say for instance, you buy ongoing business and all the assets that you acquire, you set them up in an LLC, you can escape some of the taxation issues in the state of Maryland. So the Internal Revenue Service looked at the LLC entity and they recognized a couple of things. One, it's not recognized in every state in the United States. And so it said, we're not going to change our rules for an LLC. If you become an LLC, which is a limited liability corporation, you are protected if somebody sues you. You must choose what entity you want to operate. Sole proprietor, partnership, C Corp, or S Corp.
Right.
So the C corporations is a regular corporation. It's the corporations that you see stock market or non-stock market. It's just a regular corporation that has stock and non-stock. Now the S corporation is a different kind of an entity. It is a pass-through entity. The profit or the loss passes through to your personal income tax return. Where the C corporation is a standalone. The profit or loss stays right there. Now, as a business owner, you want to be the S corporation. The S corporation is C. You are protected if somebody sues you. They can only come after the assets of the corporation.
Right.
And there's two reasons. The first is, if I have a loss, why do I want it to stay with the corporation?
Right.
I would want to pull that over to my personal return,
Right.
knock off some of my other income. And then you're taxed at a separate and a different rate with your corporations than you are with your personal return. So instead of having to pay two different rates, now you're only paying one rate, the one that is on your personal return. Okay, so the major thing that saves most people the tax dollars, and the major expense, if you're set up incorrectly, that most businesses have a problem with, is the Social Security piece. When you are in business for yourself, you are responsible for the Social Security tax at 100%. When you work for somebody else, you have half of that withheld, and the owner of the business has to pay the other half.
Got it.
So now you're in a situation in a personal service business, which most businesses are personal service. You have to pay Social Security tax. So I'm going to give you a quick example with all 5 entities. So we'll start with the sole proprietor. Sole proprietor, say, has a profit, and we're going to use $50,000 for all of the examples. So it has a $50,000 profit. The Social Security tax on that $50,000 is $6,300. Just on the Social Security tax. You haven't talked about the income tax, federal nor state, just the Social Security tax. Now let's take the second entity, a partnership. You're taxed on Social Security from the draws that the owners take for the business personally. Let's say it was $50,000. Social Security tax, $6,300 again. All right, so LLC is not an entity that's recognized, so you'll have to default to one of the other entities. A C corporation, personal draws by the owner, is taxed with Social Security. If it's $50,000, it's $6,300. Now we'll take a look at the S corporation. You can have a $50,000 profit, and you could pull $50,000 out of your business. Guess what the Social Security tax is? Just guess, anything.
Couple hundred, couple thousand, zero.
You said it.
Zero.
It is zero. Zero. You just saved yourself $6,300.
Wow.
So why wouldn't you want to be anything else? Now, there is a stipulation by the Internal Revenue Service that you still must keep yourself in the Social Security system if you are an S corporation. So what you need is an accountant that will come up with a reasonable salary that the corporation will bear in paying you. So in this example, if we did $200 a week, which is $10,400 for the year, Social Security tax on that is roughly about $1,200. $1,200, $1,300. So you just saved yourself $5,000.
Wow.
And can you imagine with profits? I had an attorney who was going to a CPA for years, and this was a well-known CPA, was filing that person as a Schedule C. And this attorney was making 3 figures, almost close to 4 figures a year. So her net profit was, she was crying because her Social Security tax was coming up $20,000, and she hadn't even gotten to the income tax portion. Now, when she got to the income tax portion, she had a lot of personal deductions that knocked that down. So her tax on the personal side might have been only $2,000. But here, she's got a $10,000 to $20,000 bill because of the Social Security tax.
Wow.
So it is important.
Makes a big difference.
It's important to be set up correctly. That's why the S corporation is the correct way to go. You save yourself thousands and thousands of dollars. That Social Security tax really starts to add up. And when you first start a business, you're going to have losses. So you want to pass those losses on your personal return for offset.
That makes sense. That makes sense.
Yeah. And then if you have a profit, then you can pull that profit over to your personal return and now knock that down with your personal expenses to offset it.
Okay. I don't know about you guys, but I learned a lot, as always, and as always. So what other tips do you have, and as far as the business and as far as filing individually?
Well, the most important thing that I will say in concluding is the tax planning piece. It is just so key and so important. If you don't tax plan, you're just giving your money away to the government. I mean, you know, which is ridiculous. And then with the fees that would be charged to do the extra work is nowhere near what you're going to be saving. So it's like, well, I got to pay the account more money to do more work. It's not going to be the same as what you're going to have to pay the Internal Revenue Service.
This is true.
And then if you're doing all of these payment arrangements with them, you're really giving the money back to them in interest and penalty over time.
Yes, interest, yes.
Yeah, so tax planning is key for individuals and for businesses. Yeah, there's lots of money can be saved. Where you think your budget is tight, you're making your budget tighter unnecessarily.
Right. Wow, ladies and gentlemen. So I want to know, we're going to take a very brief break.
Melanie's Matters TV and radio show. A word from our sponsor, Lawn Jack Events. Visit lawnjackevents.com. Now, back to the show.
Ladies and gentlemen, we are back. We have learned so much about taxes, about accounting, about planning. So now we're going to turn it to the audience, and we have a few questions. So who has the first question? Okay.
My first question is Social Security income taxable?
It can be taxable. The IRS has limitations on the amount depending on your filing status, and I don't recall what the exact figures are because they change every year. But depending on how much money you make, say for instance, as a single person, it's probably somewhere around like $5,000, something like that. If you have other income that's over $5,000, then part of your Social Security is going to be taxable. So there's like a limitation as to how much the Internal Revenue Service will let you earn before your Social Security is going to be taxed. And it can be taxed up to about 85%.
Okay, the next question I have is that in discussing the different forms of organizations, the S Corp,
yes,
where the indication is to try to pay as little into Social Security, when you're not paying into Social Security, how do you receive Social Security when that time comes?
All right, that's an excellent question. Excellent question. And for the business owners, it's really important that they understand about this. Think about it like this. With the Social Security system, you're never going to get all the money that you put into that. So the best thing that you want to do if you are a business owner, which is a part of the tax planning piece, is to set up your own retirement plan that you got the money that's going in there. And that's what you're really going to have for your retirement as money that you're setting aside in a pension plan. And I deal with professional planners who help, depending on how much money you want to have when it's time for you to retire, that you would put into a pension plan, which is a tax write-off for you as a business. So it's a double thing for you because you have money going towards your future and you're also getting a tax write-off. And then usually they set them up especially for folks who are in a subchapter S corporations, because the limitation is different. You can put out, I believe it's like about 25% of your income can go into one. And then depending on your age, there are other things you can do as far as catching up and wanting to put more in there. The Internal Revenue Service says that you still must keep yourself in the Social Security system, but it's limited. So you're still going to qualify to get a Social Security check, but it's going to be a smaller amount. You're going to get a whole lot larger amount if you set up properly in a pension plan that you set up with a professional, and not just any. I believe anyone, especially if you have, depending on the age and the period of time, because there's lots of different kinds of plans that are out there. Some of you might take a little more risk than others, but for those who are not risk takers, I just want them to know there are a lot of excellent plans out there that at a certain amount, regardless of what's going on in the market, you don't lose any money. They guarantee a certain percent. So they're out there. So that's how you're going to keep yourself in the Social Security system still and getting a better benefit by having a retirement plan for yourself. Any other questions?
Yeah, I was asking about sole proprietor.
Yes.
If you're working, like in my case, I'm working part-time,
Yes.
But I do get commissions from other things that I've got my hand in, so I get the 1099.
Yes.
Now, do I have to go down and set something up?
It depends on how much you're making for the year.
Oh, okay.
Yeah.
Okay.
You know, because again, this is something that you're just kind of, it's like the person I said who works a regular job and sells Avon on the side,
Right.
but they get a 1099 for their income at the end of the year.
Exactly.
So that's that scenario. In that situation, you don't want to set yourself up as a professional entity, not unless you're doing something at risk. If you're part-time, say, taking care of patients or something like that, maybe you're a retired nurse or something, and you're doing, now that you're taking a risk. So in that case, because of the risk, you would want to become a professional entity. But if it's not something you're really not taking a risk, it's very limited, depending on how much earnings that you're making for the year would determine whether or not you want to become an S corporation, because the Social Security tax on a couple $1,000s is not going to be a whole lot.
Right.
Yeah.
And the other question is, if one is a sole proprietor, what is the benefit of changing to an S corp, or is there a penalty to change to an S corp, and at what time frame might they do that in the year? And if you change, let's say midway, do you file as a sole proprietor for half the year and the other half for an S corp?
Yes, that's most definitely an excellent question. So to answer your question, when you're a sole proprietor, you're not a professional entity. So because you're not a professional entity, at any time during the year, you can become a professional entity. Whether you become a partnership, S corporation, or a C corp. And what would be involved in that if you wanted to become an S corporation? The federal government requires any professional entity that you're going to set up, you need to establish whatever the rules and regulations are in the state that you're operating under. In the state of Maryland, you would have to register with them first. And for a S corporation, you would be set up as a closed corporation. That's what it's called under the Maryland Code. And the date that you set that up is the very first day you're accepted as an S corporation. There's another thing that has to be done as well. So, because some people do this backwards, and I don't know how they do it because they must be lying. I've had some people come to me and they get the file identification number from the Internal Revenue Service, and then I ask them to, bring the papers so I can, do their taxes. And I was like, okay, so where are the papers from Maryland? Oh, we had to do that? We had to file Maryland? Oh, I didn't even think about that. So they're illegal. They're illegal because and they purge themselves. Because on the form, it asks you, what state did you set up your professional entity? And you have to put a date on there. So I was like, okay, let me get you straight real quick. So to answer your question, again, it would be filed with the state of Maryland, a closed corporation form. It costs $175 to get it done immediately, which is the way I suggest that it is done. I also suggest that you allow professionals as myself. I see a lot of people down there all the time trying to fill out the forms real quick and send them in, and they doing them all wrong and that type of thing. So that's just step one. Then you obtain the federal identification number from the Internal Revenue Service. And the last step to become an S corporation, you have to file a form 2553 that tells the Internal Revenue Service you don't want to be a C corp. You want to elect to become an S corporation, and it has to be filed timely, or you miss the election for the S corporation. Now, say if it was, so whenever time you become the entity, on the day that you form that entity in the state of Maryland is the day you're recognized as that entity. So you would be part year, part year. Okay. Yes.
Wow. As usual, I've learned a lot. So before we close in, tell people how they can get in contact with you.
They can get in contact with me. You can call me at 410-444-8283. Again, the number is 410-444-8283. Or you can email me at info, that's I-N-F-O, at zensaccounting.com. Again, that's info at zensaccounting.com.
Okay. Okay, and your website?
Our website is www.zensaccounting.com.
Okay. All right. So, ladies and gentlemen, it's a new year, it's 2015. Just get yourselves right, you know, as far as the money is concerned. And as usual, thank you so much for watching and listening via radio. And until the next time, take care, and I'll talk to you soon.
Thanks for watching Melanie's Matters TV and radio show, where we highlight business owners and artists, and we always talk about the matters of the community. Please subscribe. Now, new music from musician Donald Robinson.
I awakened this morning, I was filled with despair. All my dreams turned to ashes and gold. As I looked at my life, it was barren and bare. Without love, I had nothing at all. Without love, I had nothing. Without love, I had nothing.